Hey, I'm David Lillard, Tennessee State Treasurer and Chair of the TCRS Board of Trustees, and we'll convene this meeting of the Tennessee Consolidated Retirement System Board of Trustees on March 13, 2026 in the Tennessee Tower in downtown Nashville. As I said, welcome to the meeting. First order will be to have our Director of the Retirement System and Executive Secretary, Jamie Wayman, call the roll.
Thank you, Treasurer. Mr. Archer, Commissioner Bryson, Mr. Edmiston.
Here.
Secretary Hargett, Mr. Haynes.
Here.
Chief Jason Head.
Here.
Lieutenant Jackson.
Here.
Treasurer Lillard.
Here.
Director Long. Ms. Maxwell.
Here.
Ms. Moore.
Here.
Comptroller Mumpower. Commissioner Williams.
Present.
Mr. Wormsley.
Here.
I'm present as well. You have quorum.
All right, quorum being present, we're ready to proceed with business. Item number 3 is the next item, which is minutes of the December 12, 2025 meeting. They're in your packet. Or any comments, questions, or additions, deletions to the minutes? Seeing none, the chair will move approval of the minutes of that date. Is there a second?
Second.
All right, we have a second of the commissioner. All right. Any discussion? Seeing none, Mr. Secretary, would you call the roll on the motion to adopt?
Mr. Edmiston.
Here's.
Mr. Haynes.
Aye.
Chief Head.
Aye.
Lieutenant Jackson.
Yes.
Treasurer Lillard.
Aye.
Ms. Maxwell.
Yes.
Ms. Moore.
Aye.
Commissioner Williams.
Aye.
Mr. Wormsley.
Aye.
And I vote aye as well. It's unanimous.
All right, item is adopted. Next item is item 4, Board of Trustees Committee Reports. First item is sub-item A, the Administrative Committee, and Jamie Wayman, our Executive Director, chairs that committee. Mr. Wayman.
Thank you, Treasurer. So this morning we met at 9 a.m. in Conference Room N. Our action items were to approve the minutes of the Board of Trustees of the December 12th, 2025 meeting, which we did. We also heard a report from Joe Walker, Assistant Director of Employee Reporting, presenting one entity that is seeking participation in TCRS effective April 1st, 2026, that we'll discuss later in the agenda. We also provided a brief overview to committee members regarding the presentation that will be made by our actuary regarding the rates for the 2026, effective July 1st, 2026 for the hybrid plan. We also reviewed the waiver policy that will also be presented at the full Board of Trustees. I provided an update on the ARIS and data conversion projects. And then we heard from each financial empowerments area and from TCRS assistant directors regarding operations for both. And that is the report of the Administrative Committee.
All right. Any questions, Mr. Wayman, about the Administrative Committee report? Seeing none. Item B is the Audit Committee report. The Audit Committee did not meet this morning, so that item will be deferred. Item C is the Investment Committee. I chair the Investment Committee. Your Investment Committee met this morning prior to the board meeting and had a good discussion about a proposed transaction, which was approved for investment. Also had a discussion by Michael Brakebill and personnel, which you'll hear from shortly, from Barris Consulting in terms of performance and also portfolio review and generally considered matters relating to the investment portfolio. Is there any discussion or questions about the Investment Committee report? Seeing none, we'll go to the next item, which is item 5, political subdivision seeking participation. Item A is Spring Creek Utility District for the alternate defined benefit plan. Mr. Wayman, you're recognized in this item.
Thank you, Treasurer. So on page 27 of your packet, there is the Spring Creek Utility District is seeking participation in TCRS effective April 1st, 2026. They have selected the alternate defined benefit plan. That plan provides that benefits will be calculated on a formula including a 1.4% accrual factor, and that they're eligible for full or unreduced retirement benefits at age 65 and vested, or where their age plus their service total at least 90. And their initial contribution rate for the employer is going to be 4.4% of payroll. Employees are required to contribute at 5% of payroll. They're excluding part-time coverage, and they are including cost of living adjustments for their retirees. They currently have one active full-time employee that will be covered by the plan. The Administrative Committee made a motion for me to make a motion at this board meeting to approve participation effective April 1st, 2026 for the Spring Creek Utility District and TCRS, and I make such motion.
All right, is there a second to the motion? I have a second, all right. Any discussion? Seeing none, Mr. Secretary, would you call the roll on the motion to adopt?
Mr. Edmiston. Aye. Mr. Haynes.
Aye.
Chief Head.
Aye.
Lieutenant Jackson.
Yes.
Treasurer Lillard.
Aye.
Ms. Maxwell.
Yes.
Ms. Moore. Commissioner Williams.
Aye.
Mr. Wormsley. I vote aye as well. It's unanimous.
All right, item is approved then. Next item is item 6, the investment report. And we'll call on our intrepid Chief Investment Officer, Michael Brakebill, to give that report.
Thank you, Treasurer. I'd like to introduce Mark Brubaker of Veris Consulting to review our draft investment performance report for the period ending December 31st, 2025. Mark?
Okay.
Thank you, Michael. Good morning. I'll be brief. As Michael said, this is a draft form. The only number that hasn't been finalized is the strategic lending performance number. So we expect to have that soon, and it's not going to have any material impact on any of the other numbers that we look at. So starting on slide 4 of the presentation deck, just take a look at the one-year column, look at the calendar year numbers we reviewed with the investment committee earlier today. You can see the S&P 500 was up almost 18% for the calendar year, so really strong equity market in the U.S., even stronger overseas. If you look down in the middle of that, if you look down in the middle section, international equity, the EFA index was up 31.2%, and emerging markets were up 33.6%. So while we had a really strong equity market in the U.S., it was even stronger overseas, and that's a reversal of a trend that had been in place for a while. Going down, you can see fixed income returns. The Barclays aggregate, or the Bloomberg aggregate, I should say, was up 7.3%, so strong results for fixed income for the year. High yield was up 8.6%, and real estate, as measured by the REIT index, up 1.7%. The NCREIF property index, which is a private real estate, core real estate index, up 4.9. Going on to your specific results, you can see that at calendar year end, in that dark blue bar on the right-hand side of the page, the system ended the year with over $80 billion in assets under management. I think that's the first time it crossed the $80 billion mark. Just for context, last year at year end, it was $71.9 billion. So an increase of over $8 billion, all net of all cash flows for the year. Asset allocation remains well within policy targets over the long term. And then if we go to this next slide, taking a look at your total return here, again, focusing on the one-year column, for the calendar year, the TCRS was up 13.9%. And while that trailed the policy benchmark, it actually ranked near the top third of your peer group. I think that peer ranking stems from the fact that you have a slightly higher allocation to public equities than the median peer, and given the strength of the equity markets, that was the wind at your back last year. I would also point out, if you look at the far right-hand side of this page, your 10-year performance number, almost 9.1% net of fee, or gross of fee over the past 10 years. That ranks in the top quartile of your peer group and well ahead of your actuarial assumed rate of return. If you look down at the different asset classes that make up the fund, mostly outperformance across the major asset classes. U.S. equity was slightly ahead of its policy benchmark, and your U.S. equity portfolio ranked in the top 10% of your peers. So that was a really strong result for the year. International equity was a bit of a trouble spot, again, because, and one of the things that I didn't note in the capital market review, if you look in the U.S., growth stocks, especially those that are led by AI, the Magnificent Seven that you might have read about, growth stocks have been dominating over the past 3 years in the U.S. We've seen the reverse in international markets, where value stocks have been dominating. And we have a substantial allocation to quality growth within the international equity portfolio. And so that's been a bit of a headwind. The absolute results are excellent. Both the international equity portfolio up 25.3%, emerging markets up 33.8%. but both did trail their policy index because of that growth bias, or the developed markets was because of the growth bias. Fixed income had a strong year, up 8%, 8.1% to be exact, ahead of its policy index. And if you look at long term, it's beaten its policy index for all time periods. Real estate, private equity, strategic lending, these are all private asset classes. They're reported on a lag, and given the bull market and the public markets over the last 3 years, they've trailed the U.S. equity markets and the non-U.S. equity markets, the public markets. But if you look out long term at the performance, and especially go to the 10-year number, all of those asset classes have performed very well relative to their policy benchmarks. Each one is more than 2% ahead of its policy benchmark over the long term. And then the last thing I wanted to cover before turning it back over to Michael is if we go down to slide 12. Here we look at your peer universe, and again, these are public funds with assets greater than $5 billion, and you can see there that the risk-return scatter. So risk is along the horizontal axis, return is along the vertical axis, and you can see for the 5-year period, you ranked in the top 40%, so that red box is your total fund return. And then from a risk perspective, you were slightly higher than the median from a risk standpoint. And again, that stems from what I talked about earlier. You have a slightly higher allocation to public equity markets than your peer. Overall, as we reported to the investment committee earlier, we were very pleased with the overall performance of the portfolio. We think everything's working as expected. International equity has been a little bit of a headwind in the portfolio, but as we said, if you don't have a trouble spot in your portfolio, you probably aren't diversified. So we think that we expect to see that come back as we go forward into the future. Any questions before I turn it over to Michael?
Thank you. Thank you very much.
Thank you.
Thanks, Mark. So one thing I'd like to call out on this page, Mark and Joe, one of the things that they work with us on is asset allocation and how statistics on portfolio performance. The one thing that stands out on this page that's kind of interesting is in that annualized standard deviation column, where basically our fund and peers are, in the 8 to 9% kind of. That's much lower than we expect it to be. So we actually have been in this period with all the crazy news we've gone through. That's actually a lower number than when we put together our asset allocation, the forecast. We forecast more risk in the fund than that actually shows. And it's just, even as crazy as the news has been for the past 5 years, the way the portfolio's bouncing around and peer portfolios have bounced around is less than one would expect. Is that fair to say? So, I mean, our expected annualized standard deviation should be 10 to 12, and peers should be in that range, and it's 8. So it's an interesting and odd thing given just the flood of crazy news we've had over a good while. You wouldn't expect that outcome. And I have my presentation, which is, let's see, is it here? Yes. Okay. And I apologize a little bit in advance. I usually go through all these charts because I pulled them as we walked through COVID, and I kind of wanted to walk through the whole growth and inflation concept. And then, we're getting kind of the end of those themes being preeminent, and I have added some other stuff. So I'll try not to be too wordy too long. As we walk through the pandemic, housing and inflation was a huge issue, and this chart we've walked through for several years illustrates that. And it's the bottom panel. The red and the green dotted line are measures of the inflation and housing prices, specifically the year-to-year change in median home prices. And so you see the boom, the peak in there. That was when the Fed had to take action to calm things down. We had too much money flowing into homes, and there was a whole host of reasons. One is everyone was stuck at home. couldn't spend money, so they had more money than they thought they did at a time. So there was a whole reason prices just exploded. What we've seen since is those prices have eased way down. We had a little mini kind of bump up, and now they've really moderated. And why this is important is it's really hard for inflation on the economy as a whole to pick up if housing doesn't pick up, because housing is a substantial part of inflation. Goods, on the other hand, we've seen, the stuff with tariffs and all of that. You had the same peak, so you see those same peaks across the chart. This shows good inflation as it flows through the economy, and that came down a lot and even more than housing did, and it has been creeping up due to things like tariffs and kind of normalization, et cetera. The core consumer prices are still falling in a generalized sense, but goods inflation has turned up. Employment, another issue on the economy side that drives through to inflation, is employment. There's been a lot written and discussed about how we had this surprise employment number that was negative this past time. My view is that it shouldn't be a surprise. The employment market has been softening since we had our boom peak post-COVID, and it's been generally kind of slowing down ever since. And it's kind of, it's in a flat market right now. So the darker line in the center is a 6-month average, and you can see the 6-month average is just about zero. So employment is pretty soft. Housing is, softening. So those are two parts of inflation that really are two drivers that should really keep things down. The Federal Reserve, I showed at the last meeting how the Federal Reserve had kind of two opposite poles in some of their releases. The last beige book, this is an excerpt from the cover page of their recent beige book on March the 4th. Economic increase at a slight to moderate pace in 7 of the 12 districts, flat and declining activity in 4 to 5. So this is a little better than it was in the prior report that I showed you, but not a barn burner. The economy's taken off. An interesting thing I've showed you for the years is this company survey that we received from ISI. It's actually perked up lately, and so I'm going to watch this closely, which doesn't correspond to kind of soft employment and all of that, but company surveys have been pretty good. This is probably prior to the war effort. On top of kind of inflation and the economy and growth and everything, we've walked into this, as I've mentioned, for a long time with really high equity valuations. This is median forward PEs on the S&P 500, and there's just no way to characterize it except for valuations of stocks are high. And so we walk into this environment with, high prices you pay, which should moderate what you get going forward. Conversely, yields this is our benchmark FTSE Large Pension Fund Index, and it doesn't look great historically versus, like, say, 1989 or 90 or 93, but if you look through that period from 2009 to 2021, the rate period we're in looks reasonably attractive for fixed income investors. As we've discussed at the investment committee, we have had some rate drops. We thought we were going to get 2 more this year. Those investors have been pushing those out. But if we continue to have negative employment numbers, we will see rates come down, no doubt about it. Going on to different themes, as we have come through this quarter, it was interesting to watch how themes have changed. We had I had a chart, and I took it out of it, which was basically said on 2/27, here were the themes, and it was private credit and artificial intelligence. And then 2/28, which was when the war in Iraq began, that all went off the table. So prior to that, we had these themes, and this was private credit. So private credit has been a key theme. There have been some failures in different investment areas that had people excited. One was Tricolor Holdings this fall, which was a auto lending and retailing kind of organization. There was fraud. There was double pledging of collateral. Some people were really exposed to that. Simultaneously, an auto parts supplier, First Brands, filed Chapter 11. They had a bunch of liabilities that were off balance sheet, and then just prior to the to the end of the quarter or end of the month, we had a Market Financial Solutions, a large lender in London, failed, and there was definitely some fraud in that. The interesting thing about all these failures is that they have been in credit, and people are excited about private credit, but technically they weren't private credit failures because they were syndicated lending. So they really weren't that, but people got excited. What you see in the chart is a business development company, BDC income fund, and it shows you the weakness that has transpired. So that was, one of the key things that has got, and it's still to this day, there's a front page article in the Wall Street Journal today talking about outflows from private credit funds and companies struggling to meet those outflows. So it's still a theme that is important. Another one is artificial intelligence. And AI there's two kind of polar dynamics on AI, which as it affects the economy. One is the positive driver of growth. And the positive driver of growth is basically the boom in lending and investing to provide the capabilities. And so what you see here is it's a price and a revenue per share of NVIDIA, which NVIDIA is one of the key suppliers of technology into the artificial intelligence space. And the reason I look at it with both of these on here is it's not just, AI, NVIDIA's price is huge, and you can quibble with their valuation, but it has mimicked what has happened with their fundamental performance, which is their revenues are exploding. Those exploding revenues are due to people investing in those, buying those processors and putting those things to work. All of that illustrates the positive growth dynamics that AI has in the economy, which creating those data centers. However, as we walked through this quarter and we came into this year, the other side of that became a little concerning to investors. In artificial intelligence, the different models have been going through several years. People have been, there's all kinds of fears that have been raised about them. But when Claude came out and was released in December of 25, a lot of people's eyes opened up just because of how significant the improvements were in the technology. One of the first things that happened was all the software companies really started seeing a lot of softness. So what you see there, all the red charts, kind of the blood going down the curtain there, is software companies' stocks reacting to people's concerns about the long-term viability of their market because of the impact AI might make. And so this is the top 20 software companies in the United States and their investment performance in the first 2 months of the year. So you can see investors were like, oh my gosh, this is a real thing. So it was just software. There were concerns about software, and that fled. And then the second thing that transpired is, as we became concerned about it, a piece of research came out over a weekend, Citrini Research. I just put a little blurb in there. That was, probably an alarmist piece, but it was an alarmist piece talking about a scenario of AI putting all of us out of work. And I'll just put it like that. It was like, and it had people really concerned about long-term growth and viabilities of models and, what would happen. And really, like, maybe we're going to see more weakness in the employment market due to AI. And so that, on on February the 27th, those were our two main concerns, and then they got superseded by the war in Iran, which obviously that's energy prices have spiked, inflation and growth are in question. Stocks have fallen, but interestingly enough, they haven't fallen nearly as much as you might have thought. They have fallen in specific areas, but the areas that they took a hit, it looks more like a bubble was pricked than a fundamental thing. As an example, stock markets in Korea and Taiwan had been just soaring. They were rising exponentially, and it took a chunk out of those. And I think it was because those were over-levered, over-margined marketplaces that were rising much too fast. We've seen bond yields rising a little bit because of the inflation concerns due to the rise of oil and markets. And obviously we're concerned about supply chains and policy responses. So those three things: AI, the Iran war, and private credit. Those are I would say three of the things I talked to my team before that. We have a whole list of other things that everybody worries about, but those are the key things. On March the 10th, so earlier this week, portfolio was about where it was close the calendar year that you saw in your performance reports. We did hit just prior to the month end $82.5 billion, which was a nice number to see. Fiscal year to date, the return was about 8. We had a little lag yesterday, and then now things are up again today. So we're basically in that same mode right now. And it's interesting, a lot of turmoil, that you've seen, but overall the portfolio's done well and hasn't seen too big of an impact from that, and maybe less than one would have thought. So with that, I leave it to any questions you may have, and thank you very much, and glad to see you all again.
Thank you, Michael. Any questions, Mr. Brakebill? All right, seeing none, thank you for that great report, and thank you to the folks from Verisk for their good report, too. All right, next item is item 7, which is the actuarial evaluation presentation on the hybrid pension plans. And we'll call on Justin Thacker, actuary, to give us that report.
Good morning. Let me get this going here. Okay, good morning. We're here to talk about the hybrid pension plan. We come in December and talk about the legacy plan, and then we save the hybrid results for March. These are as of June 30, 2025. That's when we collect the data, the asset information, and all the work that goes in begins on June 30 of 25. So some of this information in terms of assets will be dated a little bit compared to what you just heard. This is all 6 months prior to that. But we're less focused on the assets and more focused on the results of the valuation, funding recommendations, things like that. I suppose technically we could deliver the legacy results and the hybrid results at the same time in December. That's a lot of information to absorb into one meeting, and I wouldn't want to rob you of the opportunity to hear an actual presentation at least twice in 2 different meetings. So we bring it in March for the hybrid results. The rates that we recommend for the hybrid plan will be effective July 1st of 26, so coming up soon as you start the next fiscal year. And then we'll also look at not only the funding numbers, but we'll take a look at the GASB disclosure requirements. That's the accounting requirements that shows a full market value of asset comparison to the liabilities, and we can talk a little bit about that as well. A little bit of background. We came to the board in the summer of last year and delivered an experience study, which is, what that means is we take a look at the actual results of mortality inside the TCRS plan, the mortality, turnover, retirement, salary experience, and we compare that to what we were expecting in setting our assumptions. And to the extent that we observe trends that are different than what we had been assuming in the past, we make recommendations to adjust those going forward, things like inflation is an important one. So that study reviewed the period from 2020 to 2024. We made those recommendations that this board approved last summer, and so this is the first actuarial evaluation where we're reflecting some of those assumption change. For the most part, minimal changes to the impact on the actuarial funding requirements, but we'll go over those a little bit later as well. So now that we're caught up on the experience study, it'll be 2029 before we look at that again, so it'll be a few years before we do that. And then also by way of just a little history, TCRS performs an actuarial audit on our numbers at least once every 10 years, but the trend has been every 5 years recently, and that was most recently performed in 2025. So a busy year in 2025, reviewing numbers with the actuarial auditor and the experience study, as well as all the other funding results that we bring to you each year. So 2026 will include a more standard year of no special studies, but instead the traditional actuarial funding reports. A couple of quick points on the hybrid plan. This plan was created in July 1 of 2014, so it's still relatively young. The plan is in its infancy as far as pension plans go. We have 11 years worth of data now, and the way that plan implementation worked is all new employees that the state hired from July 1, 2014 and later entered the hybrid plan. Anybody that was already in the pension plans prior to that stayed in the legacy plans, and those are the results that we delivered in December. But what that means is you start day one with 0 active employees, and it slowly grows over time as the new employees are hired throughout the different areas of state government. I'll show some charts about how that's developed in a few minutes. To compare the two plans, just to see, if you look at the hybrid plan standing alone, there's 82,000 active participants, 1,200 retirees, about 3.8, almost $4 million of annual payments to retirees, with nearly $3 billion of assets, which could sound like a lot, but we're 11 years into a fairly young plan. So if you compare that to the legacy plan, which has not received any new employees for the last 11 years, 160,000 active participants, so still twice as many actives, 189,000 retired participants with $3.5 billion in annual retiree payments as compared to the $4 million in annual payments to the hybrid plan. So again, that just with $70 billion of assets in the legacy plan. So that just still shows the big difference between the hybrid that's a growing plan and the legacy plan. I won't go through each of these points, but a couple of highlights. The main differences between the legacy plan and the hybrid plan are, because the hybrid plan includes a defined contribution component in the middle of the screen there of 5% employer contributions, it has a lesser pension benefit, so a slightly different multiplier in terms of the benefit formula. You have to work a little bit longer than the legacy plan in order to receive full unreduced benefits. And then the entire bottom section is the other key driver of the hybrid plan, which was one of the main reasons that the state made this shift. The combination of the pension and the defined contribution piece in the hybrid plan isn't necessarily a huge savings to the state compared to the legacy plan, but it's more stable, less volatility, and if there are choppy waters ahead with investment returns, there are levers in place that the hybrid plan can use to maintain that stability in the contribution rate going forward, which was the whole reason that plan was designed and created 11 years ago. If we look at the head counts, you can see starting back in 2015 was our first year of taking new employees into the hybrid plan. So you might imagine if the state's hiring patterns were consistent from one year to the next, that our group would double in the first year, and it did. So we went from 5,000 to over 11,000. And this has been a very steady growth each year, 10 to 20% increase in the population up until last year. And then this year, the population grew by 7%. So maybe we're starting to level off a little bit. You'd expect that to happen, though, as the size of the population grows. Even if it's the exact same number of new hires each year, it's going to be a smaller percentage of that main group that's getting larger underneath. As a comparison, since the legacy plans, anybody who retires or terminates in the legacy plan are obviously becoming retirees in the legacy plan, but any new replacements to those employees are not going into the legacy plan, they're going into the hybrid plan. So as you might imagine, the legacy plan participant counts have been steadily declining for the last 11 years. So we'll continue to track and monitor those in the future. Interestingly enough, if you look at this is just the teachers, so the blue bar are the legacy teachers, the orange is the hybrid teachers. This is the first year that we have more hybrid active employees than we do legacy active employees in the teacher group. And if we look at the same analysis for the state group, we actually crossed over and had more hybrid state employees than legacy's employees a couple of years ago. So 2023 was the first year that we saw more employees in the state hybrid plan. And that's just because of the different hiring patterns. Teachers tend to work a little longer, tend to have longer service careers. There's a little bit more turnover in the state group. So that means there's more replacements, more new hires. This chart is a little bit deceiving. The scale on some of these previous slides are nearly 100,000. The scale on this slide, the cap is 800. So even though that looks like a big spike in retirees, you can see the number of retirees in each of those plans below. There's still less than 1,000 retirees in the state employee group, which suggests a very minimal number of retirees. And you can see the bottom there, the number of retirees in each of those groups in the legacy plan still is a significant difference compared to the hybrid, which makes sense because if we only have been hiring new employees for 11 years, many of them weren't retirement age. So it'll be a while before the new hires over the last 11 years become eligible for retirement. A quick conversation about assets. One of the things that we that we try to do for both of the pension plans is to smooth the results for purposes of the funding recommendations. We know that the assets will be volatile. There's maybe the volatility, as Michael referred to, over the past 10 years has been less than one would have expected, but we still expect some volatility, and we would rather that volatility not find its way through to the contribution rate that you have to budget for. So we try to manage that by smoothing asset gains and losses over the course of each year. So each year we measure what we expected to receive as an asset return. 6.75 is our current expected assumption. And to the extent that the actual asset returns are slightly more or sometimes significantly more or less, we smooth that difference over a 10-year period so that we can ease that into the funding rate. We always get back to a true market value eventually, but it's a much more stable way to represent actuarial funding recommendations. This chart shows you the relative lack of volatility that we've had. 2021 and 2022 were some of the biggest differences, but across the top of the screen there, you can see what the actual return was in any of those given years compared to the assumed return. You can also see that our assumed return has been dropping over the past decade, so we were assuming 7.5%. After that experience study, we dropped our assumption to 7.25%. And then most recently in 2022, we lowered our assumption again to 6.75%. The experience study that we just finished last year, we validated that 6.75% was still reasonable going forward. So we're going to keep that for the next 4 or 5 years. And we'll monitor that again in the future. But this chart shows you the gains or losses above or below that assumed return in each of those years. And then we're recognizing 1/10 of those each year and rolling that into our smoothed actual value of assets. We still have $100 million or so of gains that we have not yet reflected in the actuarial value of assets. So that's a nice support system. If there are losses that come into the plan over the next few years, then these gains that we're still factoring into the smoothing method will help balance that out. So we desire for the actuarial smooth method to be as close to the market value as possible, even though we're willing for it to move up and down a little bit. As you can see, since this plan's been in existence, we've been hovering right around 100% of market value, ranging from this year we're using 96% of the market value because we have those $100 million of gains that we've not yet reflected. But prior to that, it's been pretty stable. And part of that's because the hybrid plan is so much smaller that even some variations in the asset return when the value of the assets were significantly less than the legacy plan, you're not going to see as much volatility as the plan is in its infancy. One piece, I'll just spend a minute on this. The hybrid plan is created in a way that has a actuarially recommended rate, and then there's a extra contribution that the state makes into a stabilization reserve so that effectively you're contributing a little bit more than the minimum requirement so that if there is volatility in the future, you can pull from that first to keep things stable in the contribution rate. And some, maybe some confusing rules in place there, but for the first 4 years, those stabilization reserve contributions were collected and counted within the TCRS assets. After 2018, those stabilization reserve contributions are kept in a separate fund, still managed with the rest of the TCRS assets though. So we have to track those separately. But the numbers across the top there are what we include in the GASB disclosure for purposes of market value of assets, not in the actual funding calculations. So you can see the values there are relatively small because those numbers are not growing. They were only 4 years worth of contributions. And then if you look down at the very bottom, you can see the accumulation of those reserves. We have nearly 300 million or so in the 240 million of reserves in the teacher plan. I'm sorry, I'm looking at the very bottom. I'm sorry, the post 2018 is that second row from the bottom. 240 million for the state, 230 million for the teachers. But when you add that next to the last row with the numbers from up above, the total amount of stabilization reserves that are available for use if there becomes volatility going forward is 320 million for the teacher plan and approximately the same for the state plan. So just disclosing that for your information. I'm going to skip over these couple of slides here. They represent our how we come up with our funding calculation rates, but I'll get to some other information later that'll help explain some of these pieces too. A quick representation of the funded status. This slide shows the actuarial value of assets. This is the smoothed assets that are 96% of the market value of assets. You can see the middle column represents the 2024 funded ratio from when we were here a year ago, and the far right-hand column represents the new funded ratio from this valuation. Each individual group had a slight increase or relatively flat from 1 year to the next in terms of funded status. That's partially because even though it was a good asset return year, we are not reflecting fully all of the asset returns because of the smoothing that we were talking about. And then that offset mostly any changes that we were making from the experience study assumptions. If we look at this on a market value, so now we bring back in the full market value of assets and that top section of those stabilization reserves that are included in TCRS assets, you can see that there was actually an improvement in the funded status across the board, with many of them now over 100% funded status compared to the accrued liability versus the market value of assets. So, which would be expected. Again, relatively new plan. We've not had a significant amount of asset volatility in the past 10 years. And the funding calculations have been designed to keep this plan as close to 100% funded as possible. When we look at the actual recommendation for the contribution rate, there's two pieces. We have the column there in the middle, which is the actually determined contribution rate. These are results from last year, by the way, the 2024 results. So we come up with the column in the middle, which is the recommended contribution rate that would say if you were not contributing extra to the stabilization reserve, what would the minimum be? And then the columns on the right is the converting those numbers into a nice round 4%. So that's the number that the state budgets each year is 4% of comp. So anything that is in between those two numbers that's above the very minimum goes into the stabilization reserve. So if we look at the differences from 24 to 25, the small changes due mainly to some of our assumption changes that I'll show you in a second. But the minimum contribution rate for the state group, the general employees went from 2.84 to 3.02. Teachers went from 2.99 to 3.15. And then that makes a very small adjustment in the way we come up with that 4% total. But again, the 4% total is what is being budgeted. The split is the only thing that really changes from one year to the next. And if we look at the drivers of those contribution rate recommendations, the changes from one year to the next, not a lot of excitement going on here because we're smoothing the asset gains. There was a minimal impact to the changes there. Not a lot of impact in the actual salaries that we reflected in the data this past year. The biggest change comes from our assumptions that we made from the experience study, almost 1/4 point in each of those. And if I break those down on the next slide, these are all the different assumptions that we went over last summer. Minimal impact across the board except for the assumptions where inflation is a driver. So we increased our inflation assumption by 15 basis points. So the cost of living benefit that we expect retirees to receive, we're now assuming a slightly higher adjustment to that. So we're reflecting that into our recommended contribution rate. And then we took the same 15 basis point increase in inflation and allowed that to flow through our expected salary increases as well. So those two things were the drivers in the small increase in the contribution rate. But again, that was just the recommended minimum rate. The overall 4% budget rate is still consistent with all the prior years from the last 11 years. A couple of points here that we monitor each year. We've talked about the size of the plan changing, that it's going to start to level off a little bit, so maybe it won't be quite as much of a risk of big swings going forward. Future investment gains and losses are always the most likely to have some volatility that we monitor and try to manage. And then we'll just keep looking at it each year, and we'll come back and make adjustments as necessary. So that's all I have. I did want to say a big thank you to the TCRS staff. They do a wonderful job of collecting and providing data to us and answering all of our thousands of questions that we have to try to make sure everything is working correctly. So I appreciate them greatly and appreciate this board allowing our firm to continue to serve you in this way. We appreciate it very much. So thank you. Any questions I can answer?
All right, any questions, Mr. Thacker? All right, seeing no questions, is there a motion to approve the actuarial funding evaluation report? We have a motion by Mr. Haynes to approve it. Is it second? The commissioner, all right. Let's see, any questions or discussion about the report? Seeing none, Mr. Secretary, call the roll on the motion to adopt.
Mr. Edmiston. Aye. Mr. Haynes. Aye. Chief Head.
Aye.
Lieutenant Jackson. Yes. Treasurer Lillard.
Aye.
Ms. Maxwell.
Yes.
Ms. Moore. Commissioner Williams. Aye. Mr. Wormsley. Aye. And I vote aye as well. It's unanimous approval.
All right, item is approved. Thank you, Mr. Thacker, for your great work by you and your firm. All right, next item is item number 8, which is the waiver policy. It is a waiver of overpayment policy. Mr. Frank LaGrippo, counsel for the TCRS, will give us that presentation.
Thank you. Good morning, Mr. Treasurer and members of the board. In your member packets, you'll find a waiver policy for the overpayment of TCRS benefits. At times, TCRS benefits may be overpaid to a member or a beneficiary based on an inadvertent error. While TCRS's plan document, which is also codified in state law, provides that TCRS shall recover overpayment amounts, it also provides that the retirement system may establish and implement policies and procedures to waive the recovery of overpayments. In 2022, Secure Act 2.0 was enacted by Congress, which includes a provision recognizing that there may be certain circumstances when a pension plan may not recover an overpayment, such as when a plan first notifies a member of the overpayment more than 3 years after the first overpayment. Secure Act 2.0 also provides that should these circumstances occur relative to an overpayment, the retirement system's failure to recoup the overpayment will not impact the retirement system's status as a tax-qualified plan. in light of the flexibility provided in both state and federal law, the policy before you provides that the retirement system must first make reasonable efforts to recoup an overpayment. The policy only applies if the member or beneficiary was without fault or knowledge of the overpayment, and under no circumstances will an overpayment resulting from fraud or misrepresentation be waived. If recoupment efforts are not successful, overpayments of $250 or less, known as de minimis overpayments, and overpayments that occurred in whole or in part more than 3 years before either the member or beneficiary was notified of the error, known as dormant overpayments, will automatically be waived under this policy after unsuccessful recoupment efforts. And in all other circumstances, TCRS may waive overpayments in whole or in part while considering the effect on the plan's funding obligations by not recouping the overpayment, the financial hardship on the member or beneficiary because of the overpayment, and the cause of the overpayment. While the treasurer is responsible for day-to-day administration of the retirement system, the treasurer often delegates many, if not all, of these duties to his treasury staff. Through the board's approval of this policy, the assessment and approval of overpayment waivers will be delegated by the treasurer to the director of the retirement system. Mr. Wayman and I are happy to answer any questions that you may have.
Okay, this policy that's being proposed is simply, as Frank said, is a waiver of overpayment policy. Overpayments are an issue always with retirement systems in various forms. Of course, we make every effort to keep overpayments to their very minimal amount and to collect, as Frank said, those that can possibly be collected. This policy is being presented today because the legislature passed a statute recently that revised this area for us, and this policy will implement that area from an administrative standpoint. So that's the reason it's before you now. Mr. Wayman, do you have any comments on the overpayment policy as director?
I do not. I think that the presentation, again, it's a standard form of business that we try to collect overpayments, and this gives us avenues by which, when overpayment fails, we have a way to address those.
Okay. Any questions or discussion points for Mr. LaGrippo or anybody else? All right. Seeing none, is there a motion to approve the proposed waiver policy? All right, motion to approve by the commissioner. Is there a second? All right, we have a second by Lieutenant. All right. Any further discussion? Seeing none, Mr. Secretary, call the roll on the motion to adopt.
Mr. Edmonston. Aye. Mr. Haynes. Aye. Chief Head.
Aye.
Lieutenant Jackson. Yes. Treasurer Lillard.
Aye.
Ms. Maxwell.
Yes.
Ms. Moore.
Aye.
Commissioner Williams. Aye. Mr. Wormsley. Aye. And I vote aye as well. It's unanimous approval.
All right, item is approved. Thank you, Mr. LaGrippo. All right, next item is item number 9, the ARES project, which is our project to update the main IT administration system for the Tennessee Consolidated Retirement System and also the accompanying data conversion projects. Mr. Wayman will update us on that now.
Thank you, Treasurer. As we've talked about before, we are in the midst of a project to replace our current pension administration system, referred to as Concord, with our new pension administration system. We selected a vendor named Sagitech to help us implement that project. The implementation or go-live date is April 2029. To date, we're about 34% through the project. This project is broken into 3 pilots. Each pilot has a certain set of functionality that we're designing in each of those pilots. At the December board meeting, we talked about that we were in the midst of pilot user verification testing for pilot 4.1. We completed that successfully. They continue to work on developing pilot 4.1 and the functionalities there, but we've moved on to pilot 4.2. Pilot 4.2 is really what I would say is the core of our business, and the functionality that's going to be delivered there is the core of our business. From helping members establish service that they may be eligible to establish in the plan, to withdrawing funds if they terminate employment and elect to take a refund. Also included in that is benefit calculations and benefit estimates. processing of retirement, processing of disability retirement benefits, and processing of payments due upon the member's death, whether that's while they're in active service or after they retired. So there's a lot of work going on. We're in the midst of the design sessions and gathering requirements for each of those. Over the next 6 months, the 3 areas that we'll start looking at is payment account setup, benefit calculations, and estimate calculations, and processes service retirement. But this pilot is scheduled to go through the end of 2026, after which we'll enter into another pilot user verification session or time period to test what has been developed so far as they continue to build the functionality out. And beginning in January of 27, we will start with the final pilot 4.3, and that functionality, which more focuses on year-end and annual processes and things like that. At the same time, we've engaged a vendor named MBS to help us with data conversion. Obviously, one of the key components of a new system is taking the data out of the current system and getting it into a format and into a, where the data is what we refer to as clean or in a structured format. So with each pilot, we're working with MBS and engaging them to take the data out of the current system for functionality in that pilot, convert those records, work with us and with the vendor on getting that data into the proper format and to meet parameters to go into the new system. Pilot 4.1, we have completed the data conversion of that. There was 90 some odd million rows of records that we looked at during that, 98% success, 99% success rate. We're still working on those few items that are still outstanding between MBS, TCRS, and Sagitech, the vendor for the pension administration solution. As I mentioned, we do that in groups with each pilot. So we're currently working, we just had a kickoff meeting for what data is going to be needed and converted for pilot 4.2, and we'll start those meetings. I'd like to indicate, this is a project that has engaged all areas of Treasury. We have accounting, financial empowerment, TCRS, the IT team. Everybody is involved and engaged in this project. This is a humongous undertaking that everybody has really delved into, and I extend my appreciation to everybody that's involved in that day-to-day, trying to get that there, because they're all doing a great job in addition to the day-to-day administration of the system. And that is the update on the ARIS project.
Okay, a very major undertaking, to say the least, for the Tennessee Consolidated Retirement System, and one's going to lead to new heights of administrative efficiency, I'm quite sure. So are there any questions or discussion points about that, Mr. Wyman? All right, seeing none, thank you, Jamie, for that good report. Item number 10 is the next item, opportunity for public comment. Is there any public comment for the board that is germane to an item on the agenda today? All right, seeing none, let the record reflect that there is none. Next item is item 11, other business. Is there any other business to come before the board? All right, seeing none, I'll just point out that on your agenda, it says that future meetings are tentatively set for June 12, 2026, and also September 11, 2026. And immediately after this session, we will have a board education session today, which is on the subject of financial empowerment / retire ready, which is led by Ashley Neighbors, the assistant treasurer in charge of that division. And that'll be a great and very informative presentation, I'm sure. And you'll receive the finest sandwich that you can possibly get for $8 or so, as a token of our appreciation as part of that. So I know you'll look forward to that. Jamie, where are we going to have that today?
That is going to be back over in the conference rooms from this morning, over in conference room N, I believe.
Okay, all right. Okay, conference room N. Be there, be square. All right. Anything else to come before the board today? Seeing none, chair moves that we adjourn. Is there a second? All right, there's a second by Mr. Wormsley. Mr. Williams, would you call the roll on the motion to adjourn?
Mr. Edmonston. Mr. Haynes. Chief Head. Lieutenant Jackson. Treasurer Lillard.
Aye.
Ms. Maxwell. Ms. Moore. Commissioner Williams. Mr. Wormsley. And I vote aye as well, unanimous to
I
to
thank
adjourn.
each of you for your service to the state of Tennessee and our people, and also to the Tennessee Consolidated Retirement System. Thank you very much. Have a great weekend.